Ladies and gentlemen, welcome to Front Page by AM Network. I'm Andhra. It's a day of major reality checks across the tech and financial sectors, and we are tracking all of it and much more. But first, a massive update for the developers and AI builders watching the segment right now. It is time to step out of the background loop. Google Cloud and AIM have officially announced Code Kitchen Season 1, India's very first coding reality show. We are talking a 10 lakh rupee prize pool, the season best trophy, and national video fame across an 8-episode video reality series. Registrations are live right now at codekitchen.am.media. Submit your concept note and secure your spot today. With that, here are the headlines of the day. Shares of Samsung Electronics dropped over 8% in early trading after its record-breaking $79 billion shareholder return plan fell short of market expectations. OpenAI CEO Sam Altman admits he misjudged AI's economic impact timeline, revealing that human and business inertia prevented immediate disruption to software companies post-GPT-4. Open source AI platform Hugging Face is exploring a potential sale that could value the company at $13 billion or more, tripling its 2023 valuation as demand for AI distribution hubs surges. Not even a record-breaking $79 billion payout is enough to satisfy Wall Street when AI cash flows are on the line. Samsung Electronics saw its shares plummet over 8% in early Monday trade, dragging down South Korea's benchmark Kospi index by 3.1%. The market reaction came despite Samsung announcing a huge 2026 shareholder return plan between 90 trillion and 110 trillion won. While the payout represents 5 times Samsung's previous record from 2020, investors were disappointed by the lack of clarity over how much of the remaining capital would go towards shareholder-focused buybacks and cancellations rather than dividends. While that payout represents 5 times its previous record high from 2020, investors reacted with disappointment, claiming that the company failed to outline share buybacks or increase its overall capital allocation. The underlying disappointment stems from how Samsung plans to distribute its AI-driven cash windfall. Now, under its existing 2024-2026 policy, Samsung maintains a commitment to return 50% of its free cash flow to the shareholders. Now, however, market analysts had anticipated higher buybacks rather than cash dividends. Executing large-scale share buybacks and cancellations remain structurally complex for Samsung. Now, a significant buyback risks pushing key affiliates Samsung Life Insurance and Samsung Fire and Marine Insurance above regulatory ownership caps, which would force them to sell shares to remain below the 10% combined threshold. Now, as a result, DS Investments and Securities Research Head Kim Soo-hyun estimates that 50 trillion won to 60 trillion won of the remaining shareholder returns could go towards cash dividends, with 10 trillion won to 20 trillion won allocated to share buybacks and cancellation. As a result, research head Kim Soo-hyun from DS Investments and Securities expects remaining funds between 60 trillion and 80 trillion won to go primarily towards the dividends, with only 10 trillion to 20 trillion won allocated to buybacks. Now, this setup directly contrasts with crosstown rival SK Hynix, which announced plans to buy back and cancel 40 trillion won of treasury shares while returning over 50% of its free cash flow. Now, financial analysts from Eugene Securities and Morgan Stanley noted that Samsung has failed to raise its payout threshold or guarantee direct treasury share cancellations, leaving investors waiting until January 2027 for final board decisions. Now, before we get to the front page take, here's something you don't want to miss. We are building India's biggest AI summit, Cypher 2026, powered by IBM Bob. And the lineup joining us in Bengaluru this October is getting absurdly stacked, with leaders like Indian chess grandmaster Arjun Erigaisi, climate tech pioneer Sumit Dagar, and creative visionary Vatsal Sheth all on one stage. This is where the next decade of AI is being mapped out. We cannot wait to see you there. With that, here's the front page take on the story. Samsung's market drop proves that in the height of the artificial intelligence boom, investors no longer reward basic corporate dividends. Because complex ownership cross-holdings restrict Samsung from burning treasury shares, the market is punishing the tech giant for choosing dividend security over stock lifting buybacks. This brings us to the question: will Samsung board be forced to restructure its cross-ownership ties to enable higher share cancellations before its next capital framework takes effect? Let us know what you think in the comment section below. This, ladies and gentlemen, is Front Page by AM Network. Like, share and subscribe, and always remember, think AI, think AIM. Sam Altman thought AI would disrupt the economy much faster. Now he says that he's wrong. In a new conversation with podcaster David Senra, the OpenAI CEO admitted that after GPT-4 arrived in 2023, he expected software businesses to be up for grabs much sooner. That did not happen. And according to Altman, the biggest reason is something AI cannot simply scale with more compute, which is human inertia. Now, Altman told Senra that he expected much more disruption immediately after GPT-4. In fact, he thought software companies would become vulnerable much sooner and that business would rapidly rebuild themselves around increasingly capable AI models. Instead, the economy kept doing what it has always done. People kept buying from the same companies, they kept using the same tools, and companies kept operating around existing software and budgets and processes and responsibilities. Altman now says that the economy simply has too much inertia. And surprisingly, he thinks that is a good thing. Now, there is an important difference between how quickly AI improves and how quickly an organization can really change. A model can get a new capability in its next release. A company cannot. Businesses, they have to change software, they have to change data access, compliance processes, budgets, employee responsibilities before a new AI capability can actually be brought in and change how work gets done. That creates a huge gap in itself between what AI can do and what organizations are ready to do with it. Altman now believes that the gap will make the transition smoother and slower. There is another interesting admission in the conversation here. Altman says even he resisted AI at certain points and was waiting for something like an iPhone moment or a product or experience that would make the transformation impossible to ignore. Instead, adoption has been much more gradual. And that may explain why the economic impact of AI has so far looked less dramatic than some of the industry's biggest predictions so far. The models have changed incredibly quickly. The economy, on the other hand, hasn't. Now, Altman also believes that the AI industry has done a rather poor job explaining what people actually stand to gain. For years, the public conversation has been sort of dominated by warnings about jobs disappearing and AI becoming uncontrollable, and even the possibility of AI destroying the world. Altman argues that this has made AI sound rather terrifying while overshadowing a much more immediate promise, giving individuals more power. He predicts AI could lead to a boom in people starting smaller businesses because capabilities that once required larger teams will become accessible to individuals. OpenAI has made a similar argument publicly, saying AI should expand individual capability, agency, and economic opportunity rather than concentrate power in a handful of institutions. Now, before we get to the front page take, here's an update. Ladies and gentlemen, Cypher 2026 is back and it's bigger and better than ever before. We talk about it every day because it generally is the room to be in this October at KTPO Bengaluru. From voice AI visionaries like Ganesh Gopalan to filmmaking disruptors like Lakshmi R. Iyer, the stage is set to be massive. So mark your calendars. October 7th to October 9th at KTPO Bengaluru. We'll see you there. With that, the front page take. Maybe the biggest AI bottleneck isn't really intelligence. Maybe it's adoption. Because models can improve every few months. Companies cannot really reinvent themselves every few months, practically speaking. And that means the economic impact of AI may arrive much more slowly than the technology itself. Altman's prediction was wrong on the speed. But that slower transition could actually give businesses and society more time to figure out what AI is useful for before it becomes or completely reshapes how they work. So here's a question I would like for you to answer. Has AI actually been slower than expected? Or have we simply been expecting the economy to move at the speed of a chatbot? Let us know what you think in the comments below. This, ladies and gentlemen, is Front Page by AM Network. Like, share and subscribe, and always remember, think AI, think AI. Hugging Face, one of the biggest platforms for open source AI, is exploring a potential sale that could value the company at $13 billion or even more, according to Business Insider. The New York-based company is working with a bank to gauge interest from potential buyers. However, there is no confirmed deal yet, but if a transaction happens at that valuation, it would be a huge jump from the company's last funding round. Now, Hugging Face was valued at $4.5 billion in 2023, when it raised $235 million from investors, including Google, Amazon, Nvidia, AMD, Intel, IBM, Qualcomm, and Salesforce. Now, a $13 billion deal would nearly triple that valuation in 3 years. And there is a reason investors are looking at Hugging Face differently today. Hugging Face has in fact grown into one of the central platforms for the open source AI ecosystem. The company had 13 million users in 2025, according to its own data. Its platform hosts more than 2 million public models and 500,000 datasets, and the number of models has now crossed 3 million. Developers use the platform to discover models and datasets in AI applications, while companies use its tools to build, fine-tune, and deploy AI systems. That by itself gives Hugging Face something that can be difficult to replicate: a huge developer community and a massive library for AI assets. And the platform importance is not really limited to the US. Hugging Face says that China accounted for 41% of downloads over the past year, making it the largest source of downloads on the platform. China has in fact also surpassed the US in both monthly and overall downloads. Hugging Face does not need to build the world's fastest or smartest model to be valuable. Its business sits one layer below the model makers. Developers can find models from companies, research groups, and independent developers all in one place. They can download them, experiment with them, fine-tune them, and build applications around them. And the ecosystem is becoming increasingly driven by independent developers. Hugging Face says that independent developers now account for 39% of downloads, up from 17% before 2022. The company is no longer focused only on language and AI models. Hugging Face acquired French robotics startup Poland Robotics in 2025 and has been building its open source robotics platform called LayRobot. The company says robotics datasets on Hugging Face jumped from 1,145 in 2024 to 26,991 in 2025. Now, the reported $13 billion valuation comes at an interesting time. Stripe is reportedly acquiring AI model routing platform OpenRouter for around $8 billion. OpenRouter and Hugging Face are very different businesses, but they point to the same trend. You do not necessarily need to build a frontier AI model to become a multi-billion-dollar AI company. You can own the infrastructure and distribution layer around those models. Now, before we get to the front page take, from Hollywood caliber creative tech to enterprise AI and fintech infrastructure, the latest additions to Cypher 2026 span literally every corner of the tech ecosystem. Hear directly from Vatsal Sheth on creative tech innovation, Varun Nagalia on enterprise transformation, and Rishabh Goyal on the future of financial risk and scoring. Step out of the background loop and join the leaders shaping 2026 and beyond. That being said, here's a front page take on the story. The AI race is creating a new kind of winner. You do not necessarily need to build the smartest model. You can own the place where developers find the models, where they download them and fine-tune them and build on top of them. Hugging Face has spent years building that layer. Now, someone may be willing to pay $13 billion for it. And if that deal happens, it could be another sign that the biggest opportunities in artificial intelligence are moving well beyond the models themselves. So let us know what you think in the comment section below. This, ladies and gentlemen, is Front Page by AM Network. Like, share, and subscribe. And always remember, think AI, think AIM. It is now time for everything that is making headlines in the world of AI and tech across the country. Here are the headlines. Prime Minister Modi has met 20 Indian space startups to capture a historic global opening, stating that India can position itself as an unmissable global hub for space technology, investment, and talent. In a structural pivot, ISRO is stepping back from building its own rockets and satellites to focus purely on scientific research, while the private sectors commercialize. India notifies a 62,500 rupee crore mobile phone manufacturing scheme with extra incentives for India-owned brands, as Vaishnav predicts a strong homegrown smartphone brand by mid-2027. AIM's tech journalist Ajay Rag will soon join Front Page Live to analyze rising revenue per employee across Indian IT majors and unpack whether AI or headcount cuts drive the shift. Most countries in the world either cannot afford a real space industry or simply don't want one. Prime Minister Narendra Modi has now told 20 Indian space founders that the gap belongs to India. Modi met CEOs and founders from 20 space startups at Seva Tirth on August 21st. The room covered nearly every corner of the industry, like rockets and reusable semi-cryogenic launch vehicles, avionics, satellites and advanced propulsion, space and defense intelligence, debris removal and AI-powered weather intelligence. Aerospace, Agnikul Cosmos, Pixel, Dhruva Space and Galax I were there. So were PureSight, Bellatrix Aerospace, Digantara, Satshore and Suhora Technologies. The rest of the list included Manastu Space, Astrobase, Take Me to Space, Vyom IC, Cosmosurf Space, Orbit Aid, Aerospace, SkySurf, Serendipity Space, Vasar Lab, and Mist.io. If you have been following the discussions on Front Page, we are affirmative that many of these space tech startups have caught your attention with their achievements and ambitions already. The founders described building their technologies indigenously, largely from scratch, and thanked Prime Minister Modi for the government support. They said opening the space sector to private players had created real momentum and genuine new opportunities. They also said that the interest was coming from outside India as well, with several international companies now looking to adopt technology built by India's private space sector. Prime Minister Modi, in fact, credited the founders for showing courage in a genuinely new sector and said that their confidence had validated the decision to open space to private capital in the first place. He pointed to the bigger opening, saying that many countries simply cannot or will not invest in space. And that gives India real room to move fast globally. He pushed them to think beyond the sector itself. He suggested space debris companies could work with environmental organizations. Companies serving agriculture could partner directly with universities and farm departments to help farmers make sharper decisions and get more out of their land. He also called for closer ties with Atal Tinkering Labs to get children curious about space early. Here's the Front Page take on the story, but before that, a quick cipher reminder. The country's biggest AI summit is back in its full glory, and the speakers lineup is power-packed to say the least. Join us this October 7th at KTPO Bengaluru. We are bringing together extraordinary minds across domains, featuring Indian chess grandmaster Arjun Erigaisi, creative media producer Lakshmi R. Iyer, and climate tech innovator Sumit Dagar. Whether it's mastering decision-making under pressure or whether it's scaling sustainable AI solutions, this is a stage you don't want to miss. With that, the Front Page take. The real message here is India's holistic strategy going forward. Modi is telling Indian space founders, and the country's advantage is not limited to talent or cost. The striking advantage here is that most of the world has simply opted out of this race entirely, which is genuinely a rare kind of opening. And this would close the moment more countries decide that space is worth the investment after all. 20 companies in one room, working from everything across from rockets to debris cleanup, suggests that India is trying to move on that window while it's still open. Ladies and gentlemen, this is Front Page by AM Network. Like, share and subscribe, and always remember, think AI, think AI. When Prime Minister Modi met 20 space founders on August 21st, it wasn't really just a photo op. That meeting could mean the opening play of a complete structural overhaul for India's space program in the coming years, especially when it comes to the private sector. ISRO is officially stepping back from the routine rocket and satellite manufacturing, handing the keys and the baton of its operational launch vehicles directly to private industry. Speaking at Business Today's India at 100 Summit, in-space chairman Dr. Pavan Goenka confirmed that ISRO will no longer manufacture launch vehicles because that responsibility now belongs entirely to private enterprise and PSUs. The transition has already begun with small satellite launch vehicle, whose technology and production rights were transferred to Hindustan Aeronautics Limited. Next in line are ISRO's workhorses, the Polar Satellite Launch Vehicle and Launch Vehicle Mark III. Crucially, public sector companies will be barred from bidding for the PSLV and LVM-3 production lines, ensuring that private domestic players take sole ownership of their commercial builds. Now, this structural shift also coincides with an unprecedented talent drain inside the National Space Agency. More than 100 senior ISRO scientists and key project directors have recently resigned or taken voluntary retirement to join heavily funded private startups, including Skyroot, Agnikul Cosmos, and Pixel. Now, the exodus reached a point where the Department of Space had to issue an extraordinary memorandum halting voluntary retirements for scientists working on flagship missions like Gaganyaan, Chandrayaan-4 and Bharatiya Antariksh Station. Now, rather than fighting this talent shift, India's space strategy is adapting to it by repositioning ISRO purely as advanced R&D and deep space exploration body. ISRO has already transferred over 120 proprietary technologies to private companies and in-space plans to hand over the operations of a new launch site to a private operator within the next 4 to 5 months. Now, the ultimate goal is scaling India's space economy from $8 billion today to $44 billion by 2033. Driven by an ownership-based model where private firms own satellites, they operate rockets, and monetize downstream space data. Government demand will act as the anchor customer, with the Department of Defense already placing orders for 31 satellites with private manufacturers, while ISRO builds another 21 under the same program. Now, before we get to the front page take, here's an update you cannot miss. The latest additions to Cypher 2026 span every corner of the tech ecosystem. Hear directly from visionaries like Vatsal Sheth on creative tech innovation, Varun Nagalia on enterprise transformation, and Rishabh Goyal on the future of financial risk and scoring. Step out of the background loop and join the leaders shaping 2026 and beyond. That being said, here's the front page take on the story. What looks on the surface like an attrition crisis inside ISRO is actually the rapid birth of India's commercial space industrial complex. By stepping away from assembly lines and letting top talent migrate to startups, ISRO is adopting the NASA playbook by focusing its government budget on deep space science, while private companies scale the commercial launch market. Moving PSLV and LVM-3 production exclusively to private hands confirms that India is no longer treating space as a state enterprise, but as a high-growth export market. So the question that I would like to ask each of you is this: will transferring rocket production to private industry allow India to capture a major share of the global commercial satellite launch market over the next decade? If so, how? And if not, then why? Let us know what you think in the comment section below. This, ladies and gentlemen, is Front Page by AM Network. Like, share and subscribe, and always remember, think AI, think AI. 62,500 crore rupees, 5 years, one target. An Indian company that finally builds phones under its own name, not just assembles somebody else's. And here's the part that actually makes this interesting. The government says Indian companies are already competing to become that first real homegrown brand, and it won't say who. MeitY notified the mobile phone manufacturing scheme MPMS 62,500 crore rupees running financial year 27 through financial year 31. Two tracks. Track 1 rewards manufacturing scale, incentives from 2.25 to 5%. Track 2 is squarely for Indian-owned brands, a flat 5% plus another 3% if the design and R&D happen in India too. That's up to 8% just for building something genuinely Indian, top to bottom. Now there's further 1.5% on top of either track for sourcing key components domestically, as long as those local parts show up in at least a quarter of everything a company ships in a year. For the Indian brand track specifically, the bar isn't just the revenue. The company has to be registered in India, hold its IP and trademark in India, have Indian citizens in management control, over 51% Indian shareholding, and its own R&D and design capability, not outsourced. Vaishnao's own words were quite blunt. The design, the IP, and the brand have to be genuinely Indian and able to compete with the best in their category. The government's promised a meticulous evaluation to make sure that the ownership is real and not just a shell. Now, this is not coming out of nowhere. The scheme that built India's mobile manufacturing base in the first place, the PLI for large-scale electronics, ended this March. MPMS replaces it, but with a different aim. That scheme was about getting phones built here at all. This one is about who actually owns what gets built. Vaishnao has said that India tried this once before and lost local brands to tax issues and Chinese competition. This time he argues that the manufacturing ecosystem is already back in place. So the brand is the missing piece. And here's the number he's actually literally staking his name on. He says India could have its first strong homegrown phone brand by mid-2027. That's not a 5-year promise. That's under a year already. Now, before we get to the front page take on the story, an update you don't want to miss. We are building India's biggest AI summit, Cypher 2026, powered by IBM, and the lineup joining us this October in Bengaluru is getting absurdly stacked. With leaders like Indian chess grandmaster Arjun Erigaisi, climate tech pioneer Sumit Dagur, and creative visionary Vatsal Sheth all on one stage. This is where the next decade of AI is being mapped out. We cannot wait to see you there. So if you are serious about AI and tech, this is where you need to be. With that, here's the front page take. Vaishnao's made versions of this prediction before. Back in January at Davos, he told the world India was 12 to 18 months from its own brand, an Indian brand in his own words. This scheme is the financial machinery meant to actually make that timeline stick this time, instead of staying a conference soundbite. So here's the question that I would like to ask you. With Indian companies reportedly already competing for this, kept unnamed for now, is India's first real homegrown phone brand actually under a year away? Or is mid-2027 just this administration's newest version of a promise it's made before? Let us know what you think in the comments below. This, ladies and gentlemen, is Front Page by AM Network. Like, share and subscribe, and always remember, think AI, think AI. Ladies and gentlemen, thank you for staying tuned and welcome back to another deep dive at Front Page by AM Network. I'm Andhra, and today we are essentially answering a question that is currently hanging over every boardroom, engineering floor and earnings call across Indian IT. And the question is this: is artificial intelligence finally delinking revenue from headcount, or are we just watching classic cost-cutting rebrand itself as an AI revolution? Now, in the Q1 FY27 earnings, India's top 5 giants, TCS, Infosys, HCL Tech, Wipro and Tech Mahindra, generated a massive combined revenue of $25.6 billion. Now, across all 5 terms, dollar revenue per employee went up year over year. On the surface, the narrative sounds clean. Enterprise generative AI and agentic delivery tools are making engineers more productive, allowing IT majors to squeeze more value out of literally every billable hour. But when you sit and look beneath all the headline figures, the data paints a far more complicated picture. While TCS went on a hiring spree of over 9,000 employees, firms like HCL Tech, Tech Mahindra and Infosys continued to shed headcount. In fact, long-term CAGR data suggests productivity growth over a 7-year horizon. It remains remarkably flat. So joining me today to untangle the numbers, the narrative, and really getting the pulse and the reality on the ground is my colleague and AM tech journalist, Ajay Rag. Ajay, welcome to the show. It's really good to have you here.
Thank you, Andhra. It's a pleasure to be here always.
Our pleasure, always. Ajay, starting with the baseline data here, in Q1 FY27, dollar revenue per employee went up across all 5 IT majors, but the headcount strategy behind these particular numbers were divergent, to say the least. TCS added over 9,200 people, while HCL Tech shed more than 3,200. So, Ajay, just walk us through these very contrasting strategies and how are different companies achieving this per employee revenue uptick? Ajay.
Yeah, Andhra, thank you for setting up the context. So as you rightly pointed out, it's a very distinct strategy between compared to each companies. From an ordinary man's perspective, like an investor perspective, the narrative is that revenue per employee is up across all these IT companies, and that means that AI-led automation must be working somehow, especially from a talent perspective. But if you look closely, these are like different stories. Like when we start with TCS, it's the most counterintuitive one, because like everyone assumes rising revenue per employee means companies are cutting people. But when you look at TCS, they've added some 9,200 odd people to their workforce in the last quarter, compared to like on a sequential basis. So that is giving them at least like 6% odd rise in revenue per employee, which is a very impressive one on the paper. But at the same time, if you look at from a year-on-year perspective, TCS total headcount is still more than 19,000 people below their headcount last year. So what I'm trying to say is that TCS revenue is growing faster than its workforce. How its workforce is getting rebuilt. So that is one story. And when you look at HCL Tech, Infosys, they have taken the completely opposite route. Like they shrank their headcount sequentially, and still they saw their revenue per employee rising. And Wipro is sort of an outlier, because they've also added some 888 people, and but they've only seen around 1% revenue growth, and their operating margin actually fell from 17.2% to 16%. So what I'm trying to say is that you cannot put all these eggs in the same basket, because all these companies have their own strategies. How they're sort of doing it is very different. So I think each company should be studied specifically on this front.
All right. Ajay, Infosys, in fact, stated in their call that AI-led services now account for 8.2% of their revenue. Having said that, they trimmed their full-year constant currency growth guidance down to 1.5 to 3%. Now, if AI services are becoming a meaningful percentage of top-line revenue, why aren't overall growth forecasts reflecting that sort of momentum?
Yeah, that's a very interesting question, Antara, because I remember this same question being asked in the last quarterly earnings call of the company, and the CEO Salil Parekh was addressing that. So basically, according to him, the reason for cutting the guidance 3.5% to 3% was because the macroeconomic conditions really does not come up with the same expectation of the company. And on your question on AI, that how like when an AI as a part of revenue is growing this much, why the company is seeing a macroeconomic headwind? So the point is that 8.2% is still a minority slice of the business of a multi-billion-dollar company like Infosys. Like we are not talking about the 90 plus odd percent of the business that the Infosys, the big revenue generators of the business is. We are not talking about that particular business. We are talking about the 8.2% here. So I think like that traditional business, 90 plus odd percent business is still facing the softness, delayed discretionary spending, delay in client approvals, and how clients are cutting the what do you say deal sizes and everything. So all these headwinds are still there for that company, as for all other IT companies as well. So when we are saying AI revenue is growing, it's mathematically too small to move the overall needle of a company of that significant scale like Infosys. So I remember talking to Sudhi also about this last time when we met. So that's it.
Ajay, then you also have Wipro here, which added 888 employees with revenue at $2.61 billion, bringing their quarterly revenue per employee to around $10,760. But their operating margin in IT services, it slipped to 16%. Now, CFO Aparna Iyer has in fact given a statement on this, noted that strategic investments they're creating near-term margin volatility. So what are those investments, and why is it that Wipro is taking a harder margin hit than the rest of its peers?
Yeah, that's actually interesting. So when you look at it, Wipro, there is a lot of narrative around Wipro, what is happening in Wipro, what's the AI, play that the company is going through. So my point is that it's very important to separate what we actually know about Wipro from the company, from their earnings call, and from the executives there, and what we are speculating, right? So what we know for certain is that Wipro's operating margin in the IT services business slipped, and we all know, from 17.2% to 16%, as you pointed out. And on the earnings call, CFO Aparna Iyer specifically mentioned that the company is continuing to invest in people and strategic priority areas. I mean, like she also addressed that will actually create a near-term margin volatility in the company, and they're okay with it because they want to build a stronger foundation for the future growth of the company. So if you ask me what are the strategic priorities area, I mean, according to me, it could be like, AI infrastructure, investments that all these IT companies are making right now, or, like upskilling programs where they're upskilling their own current employees, and they're also looking at lateral hiring, things like that, because they need more people to do this. And we extensively spoke about forward deployed engineers and everything. So they need that kind of talent base also. So I think company like Wipro is actually, investing in that bit. So it's very hard to, give that, because Wipro is the only one of those companies, whose revenue per employee gain is being paid for with margin, rather than coming from attrition or outsized revenue growth. So it's a very interesting company to look out for.
Absolutely, Ajay. Now let's also get into the core of the article. You cited data from Unearth Insight founder Gaurav Vasu, who made a crucial distinction, right? About 60% of this revenue per employee rise is driven by workforce rationalization and optimization, while only 40% comes from actual AI-driven efficiency gains. Ajay, if you could break down that 60-40 split for us, how much of today's AI productivity story is simply, just management running, I would say, leaner operations?
Yeah. I remember talking to the company Anand Insights Gaurav Vasu. So the company's estimate is that, like roughly 60% of the revenue per employee improvement across the sector is coming from workforce rationalization, which is like, leaner headcount and things like that, and only around 40% is coming from genuine AI-driven efficiency gains. I mean, like that is sort of, fairly damning the AI changing the IT industry narrative, because we're still talking about the older way of cutting people just to get, better margins and stuff like that. But there is a
Right.
nuance to it, because, the 60-40 split that we're talking about, it can't be separate from each other. Let's say a meaningful chunk of that 60% rationalization exists because companies understood that, AI-led automation can reduce the need for that many people. So basically, it means that, earlier 10 people used to do one job, and now with AI, 2 people can do that job. So 8 people are not required. So in a way, AI is also helping in workforce rationalization. So I'm saying that 60-40 cannot be treated as two different things, because
Okay.
AI is helping in this workforce rationalization, which is helping the company to overall reduction in headcount.
Understood. Ajay,
Yeah.
in your conversations across the industry, would you say that the enterprise clients are aware of this distinction when IT service firms pitch AI-driven delivery to their clients? Are buyers getting actual technical non-linearity, or are they just paying for restructured offshore delivery teams?
No, the evidence suggests that, the clients are very aware, and they are not waiting for vendors to sort of clarify this distinction. But I think companies are coming to a point where, they are looking at more outcome based, pricing. So outcome based,
Right.
what do you say, like more outcomes basically. Like whatever services they're getting, they're looking more outcomes. So I don't think they're very much concerned about, how many people and, things like that. I think that's how the company is also going, and also the industry is also growing in that line, right? I mean, let's say the whole bench strength model is getting disrupted. So now it's like one task is one deal is being assigned, and then this deal is being getting done. Let's say this particular period with this many people. So they don't care about how many people are getting to do this job. So I think that's how the industry is growing. But it's too early to talk about it, because
Okay.
vendors, as you asked, the clients are very much aware of it.
Okay. Thank you for that,
Yeah.
Ajay. Okay, if we step back from this single quarter and look at the multi-year trend, the narrative, I would say, gets even more revealing, because, the Unearth Insight data in your report shows that the revenue per employee has only crept up gradually since pre-pandemic financial year 19. Now, over 7 years, Infosys grew per employee revenue at a CAGR of, I believe, 2.47%, TCS at 0.59%, then there was HCL Tech at 0.45%, and Wipro actually saw a negative of minus 1.45%. Ajay, given how heavily the industry has marketed automation and cloud transformation, and how Gen AI over these past 7 years, why are these multi-year compound growth rates still essentially flat, or I would say in low single digits? Why do you think that is?
Yeah, I mean that's a very interesting number for me also because we keep talking about 1 quarter, 2 quarter, or 1 year, but 7 year data is something that is very startling number for me because, like as you pointed out, in Infosys grew revenue from like 2.47%, TCS 0.59, and all these numbers that you mentioned. That's 7 years. So that is the period that included the cloud migration wave, or the years of automation investment the companies have done, or now we're talking about the entire Gen AI moment that we are seeing through. So all through that, the actual compound productivity gain at the top of the industry is either flat or barely positive, or Wipro's case, it's outright negative. So the understanding is that, like the analyst that I spoke to gave pointed to a utilization as a, what do you say, a major driver for all these things, like getting more billable hours out of existing employees and reducing the bench time. So even today, some of what we are calling AI-driven productivity may still be the industry pulling its traditional utilization lever, just with better technology called AI. So I think in a long time frame like 7 years, this is not creating a lot of what do you like meaningful impact.
Okay, all right. Ajay, Praveen Bhadada from Global noted in your piece that the last 8 quarters were primarily focused on, improving utilization, but the industry is now trying to bring in, true non-linearity. What does true non-linear growth look like in an industry which is historically built on, selling billable hours and body shopping? Would you say that it's even possible without fundamentally changing the business model in itself?
Yeah, I feel like that's the $1 million question. Even the industry is also asking for a very long time right now. No, I mean, Antara, I would like to say that like the simplest way to think about non-linear growth is, like revenue growing without headcount growing at the same rate. I think that's the most accessible definition for that, and that's the biggest break industry has been looking, right? I mean, IT services had a pretty close relation between people and revenue. Like more, like we mentioned earlier in the earlier part of the conversation, like more people means more projects, and more projects means more revenue. Like when you look at IT services companies for quite some time, for decades actually, they always associated the revenue with people, which means more deals mean more revenue, which is like translated to more people being hired and being put in projects. So I think that's the norm. That was a norm for a very long time. I think that is significantly changing right now with all these outcome-based pricing and new pricing strategies being introduced into the system. So I think IT services companies are not yet really ready to embrace that, but I think they are sort of forced to do that, and I think that's going to be the norm going forward. And specifically about Praveen Badada, in my conversation with him also, we spoke about this. I feel like he is expecting profit per person to become a more important metric. But exactly what replaces the traditional billing model is still an open question. How companies are going to do this, and all these things are there, but I think, yeah, it's too early to talk about it.
Okay, all right. Let me also bring this back to the developers and system architects and tech leads who read AIM every day, who tune into front page every day. If 60% of this productivity push is workforce rationalization and 40% is AI delivery, what does this environment really mean for the daily work life and job security of software engineers in Indian IT?
Yeah, I mean that's a very interesting. This is a light cut in my place, but so what I'm trying to say is that it's very hard for all these employees also, because like when you look at the macro tension, there is a bullish market-facing narrative that all these net headcount reduction is happening in all these companies. And let's say if you're an engineer, you're working in one company, and the next day a few people in our company are getting laid off and all these things. So it's very hard to give an answer, but I would feel that there's a broader tension here, that on one side companies are talking about AI driven productivity and how they're improving their workforce and everything. On the other hand, several of them are operating with smaller teams, like we spoke about TCS for that matter. Like sequentially they have grown, but on an annual basis they have reduced employees, and that is another norm going forward. Because let's say, I hope you remember last time during TCS AGM, I think the chairman was talking about the same, that they're expecting to have same number of AA agents and same number of employees going forward TCS as a company, which is the largest employer, in the country. So if the chairman of that company is feeling that they'll have similar number of AI agents and human employees, that's a big sign that either engineers have to upskill themselves and do whatever they can to be to stay relevant, rather than being cannibalized by AI.
Makes sense. Makes sense,
Yeah.
Ajay. Uh, Ajay, looking ahead through the rest of FY27, what is that single key metric or a signal that you will be sort of tracking to determine whether Indian IT is genuinely, transforming, or is it just navigating another lean economic cycle?
Yeah, like I mentioned, profit per employee is something that I will actually look for, because
Okay.
revenue per employee can go up simply because you reduce headcount, which is something that the companies have been doing very, very long time now. Like we saw that with HCL Tech, Infosys, because they reduced their headcount and they've seen a improvement in their revenue per employee. But profit per employee harder to sort of make, because if margin under pressure, they can't just reduce employees and then get a better revenue per employee. So what I'm watching through FY27 is whether companies can increase their revenue per employee while keeping margins stable or improving them, which Wipro couldn't do, I think, unfortunately, in this last quarter.
Right. Right.
So yeah, we're starting to see that, and other than Wipro, almost all other companies have done that. They have improved their profits. I mean, though not in a great scale, but they have at least managed to do it. So I think if the companies are able to maintain that trend, I think it's great.
Okay, all right. Ajay, thank you so much. In the interest of time, again, I'll have to wrap the segment, but this has been an incredibly educational conversation, I would say. And that, ladies and gentlemen, brings us to the end of today's deep dive. The Q1 financial year 27 numbers make one thing very clear. Indian IT's revenue per employee is rising, but we are very much still in the transitional phase where workforce optimization leads the charge, and AI-driven non-linearity is only beginning to show its hand. So a big thank you to Ajay Rag for breaking down his reporting and really getting into the nitty-gritties of the numbers with us today. And you can read, ladies and gentlemen, you can read Ajay's full article and detailed data breakdown over at Analytics India magazine. And to everybody, to our audience of developers and architects and engineering leaders and anybody who has tuned in and watching the segment right now, are your teams experiencing genuine AI-driven productivity leaps? Or are you simply feeling the pressure of leaner team structures? This is a question that I would like to leave you with. Let us know your thoughts in the comment section below, or reach out to us directly. Do not forget to like, share and subscribe, and hit the notification bell for more AIM update. I'm Mantra. This is Front Page by AIM Network, and we'll see you again soon.
Good evening and welcome to Front Page by AIM Network. Before we get to the headlines, here is something that you don't want to miss. IBM Bob presents Cypher 26 is back and it is going to be bigger than ever. It is happening on October 7th to 9th at KTPO Bengaluru, featuring Arjun Erigasi, Vatsal Sheth, Navya Naveli Nanda, and many more visionaries. Different backgrounds, different perspectives, and one big stage. So get your passes now, and we'll see you there. Now, let's get straight to the headlines. NVIDIA reportedly warns major customers that surging memory costs will drive AI server prices up by over 15% starting next year. A humanoid robot completed a 100-meter sprint in 9.39 seconds at the World Humanoid Robot Games in China, surpassing Usain Bolt's legendary 9.58-second human world record. The Andhra Pradesh government has granted approval to the AM AI Factory Private Limited to build a 512 megawatt green integrated AI data center in Visakhapatnam, backed by an investment exceeding 31,000 crore rupees. India's FTA push targets 69 countries and $12 trillion export opportunity as Japan outreach seeks more investment, technology, and manufacturing partnerships. Serendipity Space co-founder and CEO Antariksh Paricha will soon join Front Page Live to discuss making space a part of the pharmaceutical supply chain. If you thought the AI boom was only making GPUs harder to get, here is another twist. NVIDIA's AI hardware is about to get even more expensive. According to a new Bloomberg report, some of NVIDIA's biggest customers have been told that prices for servers containing its AI chips could rise by more than 15%. What is the reason, you might ask? Memory prices are soaring. And this isn't just about one chip. The hikes are expected to hit systems built around NVIDIA's flagship Vera Rubin and Grace Blackwell platforms. So what is pushing up the price of some of the most expensive machines in the world? Let's break it down. Here's what we know. The price increases are expected to hit systems shipping early next year. Server companies working with major data center operators including Microsoft, Google, and Oracle have reportedly already started notifying customers. And NVIDIA isn't simply deciding to charge more. There is a much bigger problem: memory. NVIDIA's AI accelerators need large amounts of RAM to run effectively. But the companies that dominate memory production like Samsung, SK Hynix, and Micron are struggling to keep up with the AI demand. Supply is rising, but the demand is rising even faster. And that is sending memory prices higher. This is where the AI infrastructure story gets even more interesting. The AI boom isn't just creating demand for GPUs, it is creating a massive appetite for everything around those GPUs. NVIDIA has enormous pricing power because demand for its AI accelerators still outpaces supply, and customers have very few alternatives. The company can already charge tens of thousands of dollars for an AI chip with reported gross margins around 75%. But now even NVIDIA faces a cost it cannot simply absorb. The bottleneck is further down the supply chain, and the pressure isn't limited to data centers alone. Tom's Hardware reported earlier this month that NVIDIA has also raised prices for its gaming graphics card. So the AI squeeze is being felt beyond the AI industry too. The bigger question now is what this means for the AI build-out. Amazon, Microsoft, Google, and Meta are all developing their own AI chips. The goal is to become less dependent on NVIDIA. But for now, they still heavily rely on NVIDIA hardware for their data centers. And there's another catch. Even if they build their own chips, they still need memory, which means they still need Samsung, SK Hynix, and Micron. And this is happening as AI data center projects already face delays, labor shortages, tighter capital markets, and resistance to new developments. Add another 15% or more to hardware costs, and those projects could get even harder to build. Now, this brings us to the front page take. But first, Make sure IBM Bob Presents Cypher 2026 is on your calendar. October 7th to 9th, KTPO Bengaluru, with Vatsal Sheth, Sumit Dagar, and Navya Naveli Nanda joining the lineup. Come for the conversations, stay for the ideas. And most importantly, get your passes now. Now, let's get back to the front page take. The AI boom was supposed to give us cheaper, faster, and more powerful computing. Instead, it is putting pressure on the entire hardware supply chain. NVIDIA needs memory, its customers need NVIDIA, and everyone is competing for the same limited supply. That's the irony. NVIDIA has some of the strongest pricing power in the AI industry, and now even NVIDIA's customers are being told to pay more. So is this supply the cost of building AI at an unprecedented scale? Or will rising hardware prices eventually put the brakes on the AI boom? We may get another clue next week when NVIDIA reports its fiscal second quarter earnings. Because right now, the biggest question isn't how much AI we can build. It is about how much it is going to cost. So what do you think? Is AI making computing more powerful or just more expensive? Let us know what you think in the comments below. This is Front Page by AIM Network. Like, share and subscribe. And always remember, think AI, think AIM. For 17 years, Usain Bolt's 9.58 second 100-meter sprint stood as the absolute ceiling of terrestrial speed. That ceiling was officially breached on mechanical legs in Beijing. During the second edition of the World Humanoid Robot Games, the Tiangong Ultra robot, built by the Beijing Humanoid Robot Innovation Center, clocked a 9.39 second heat. This ended up beating Bolt's 2009 Berlin world record. It wasn't the only machine to clear the mark. Smartphone maker Honor's Lightning robot crossed the line in 9.47 seconds during the heat, following a prep test run where state media reported it registered an astonishing 9.32 seconds at peak speeds of 14.5 meters per second. The performance marks a staggering technological leap in bipedal locomotion. At the inaugural edition of the Games last year, Tiangong Ultra won the 100 meters in 21.5 seconds. This means the engineer stripped over 12 seconds of its operational time in just 12 months. However, the extreme speeds revealed clear mechanical limitations too. Unable to decelerate smoothly past the finish line, Tiangong Ultra stumbled into protective mats along the track sidelines while Lightning suffered a mechanical shutdown and was removed via a stretcher. Beyond headline-grabbing sprints, the Beijing Games brought together more than 2,000 humanoid robots and 666 teams from 16 countries. The 51 featured events ranged from boxing and football to practical domestic tasks like folding laundry, cable wiring, and material transport. This brings us to the front page take. But before we move ahead, don't forget that IBM Bob Presents Cypher 2026 is coming to KTPO Bengaluru this October from 7th to 9th. You'll see Lakshmi R. Iyer, Pratyush Kumar, and Navya Naveli Nanda take the stage. It is going to be an exciting mix of ideas and perspectives. So get your passes now. See you there. And now let's get back to the front page take. Tiangong Ultra's 9.39 second sprint is proof that physical AI is outgrowing human physical limits far faster than expected. While running straight into padded crash barriers shows that deceleration and real-world balance are still works in progress, the jump from 21.5 seconds down to 9.39 seconds in a single year demonstrates that bipedal hardware is rapidly maturing. Sprinting faster than Usain Bolt isn't just a gimmick, because solving high-speed balance and torque control is the exact engineering that bridges the need to put humanoid robots to work in industrial logistics and home care. Now the question here is, will humanoid robots transition into everyday factory and household workers before engineers fully solve their real-world stability and deceleration challenges? Let us know what you think in the comments below. This is Front Page by AIM Network. Like, share and subscribe. And always remember, think AI, think AIM. Andhra Pradesh is making a major move in India's digital infrastructure race. The state government officially issued a government order approving AMAI Factory Private Limited to construct a 512 megawatt green integrated artificial intelligence data center in Visakhapatnam, entailing an investment exceeding 31,387 crore rupees. The facility is slated for development at Amanam village in Bhimunipatnam Mandal. IT Secretary Bhaskar Katamneni confirmed that the project carries a strict completion timeline of 2 years and 4 months, and it will generate up to 1,000 regional jobs. To ensure rapid execution, the state government is providing both non-fiscal and fiscal incentives. Non-fiscal support guarantees essential power infrastructure development and dedicated water supply to handle the facility's high computing coding demands. For the fiscal incentives, there's an outline full exemptions from stamp duty and electricity duty, underscoring Andhra Pradesh's commitment to attracting heavy digital investments and turning Visakhapatnam into a key AI hub. This brings us to the front page take. Before we wrap this section, here's something that you don't want to miss. And this is something that is coming right your way. IBM Bob presents Cypher 2026 is happening on October 7th to October 9th at KTPO Bengaluru, featuring Arjun Erigasi, Vatsal Sheth, and Navya Naveli Nanda. Different backgrounds, different perspectives, and one big stage. So don't miss it and get your passes now. We shall see you there. Now, let's get back to the front page take. A 512 megawatt capacity project in Visakhapatnam demonstrates that India's AI infrastructure push is expanding well beyond traditional metro hubs. By pairing massive private capital with complete state duty exemptions and power setup, Andhra Pradesh is betting that regional coastal hubs can power the heavy energy demands of sovereign AI compute. Now the question here is, will state-backed power infrastructure and tax exemptions turn Tier 2 coastal cities like Visakhapatnam into primary hubs for India's AI data centers? Or is that still a distant dream? Let us know what you think in the comments below. This is Front Page by AIM Network. Like, share and subscribe. And always remember, think AI, think AIM. India is trying to do something it has struggled with for decades. It is trying to turn a huge domestic market into a much bigger export machine. And the scale of the trade push is enormous. India's expanding FTA network could eventually cover 69 countries, representing more than 75% of India's exports, while the markets covered by recent deals represent roughly $12 trillion of import demand. And now, as Commerce Minister Piyush Goyal lands in Japan with India's largest ever business delegation to the country, the FTA strategy is meeting a second objective. It is to get Japanese capital and technology to manufacture in India. India currently has 15 FTAs in force covering 27 countries. Another 9 agreements involving 42 countries are either nearing completion, awaiting implementation, or under negotiation. Together, that would take the network to 69 countries, covering around 75% of India's export. And this is a dramatic change in strategy. Since 2021, India has finalized deals involving countries and blocs, including Australia, the UAE, Oman, New Zealand, EFTA, the European Union, the United Kingdom, and the United States, alongside Mauritius. The recently concluded agreements cover 38 countries whose combined imports are about $12 trillion. India's chief FTA negotiator Darpan Jain says that these deals are no longer optional for manufacturing. They are about getting Indian products into much larger markets while attracting investment and connecting India to global value chains. India can sign the deals. The harder part is making Indian companies actually use them. A June 2026 GTRI assessment found that Indian exporters were using preferential tariff benefits on only around 20 to 30% of eligible exports, compared with roughly 60 to 70% for exporters from partner countries. So the $12 trillion figure is an addressable market opportunity. not $12 trillion of guaranteed Indian exports. And that distinction matters because this is where Piyush Goyal's Japan visit becomes important. He is leading more than 200 business representatives across Tokyo, Nagoya, and Osaka, with discussions focused on manufacturing, semiconductors, AI, clean energy, automobiles, healthcare, and other strategic sectors. India-Japan trade reached around $27.5 billion in fiscal year 26, while Japan is India's fifth largest source of FDI. More than 1,400 Japanese companies operate in India. Goyal's pitch is now much bigger than getting a few more investments. He has called for the number of Japanese companies operating in India to double this decade. Japan has also set a target of 10 trillion yen of investment in India over the next decade, with AI, semiconductors, batteries, critical minerals, and next-generation mobility among the focus areas. This brings us to the front page take. Before we get to that, here is something to look out for. IBM Bob presents Cypher 2026. It is happening on October 7th to 9th at KTPO Bengaluru, featuring Arjun Erigasi, Vatsal Sheth, and Navin Aveli Nanda. Different backgrounds, different perspectives, and one big stage. So don't miss it. Get your passes now and we shall see you there. Now let's get back to the front page take. India is no longer simply signing FTAs. It is trying to build the factories, supply chains, and foreign investment needed to actually exploit them. That is the right strategy. But the real test is utilization. Can Indian manufacturers become competitive enough to turn preferential access into actual exports? Because 75% market coverage sounds impressive. What matters is how much of that Indian market can actually win. So here's the question. Are India's FTAs finally creating the export engine India needs? Or will poor utilization and weak manufacturing competitiveness leave the $12 trillion opportunity largely on paper? Let us know what you think in the comments below. This is Front Page by AIM Network. Like, share, and subscribe, and always remember, think AI, think AIM.
Ladies and gentlemen, hello and welcome to Front Page by AM Network. I'm Andhra. Today we are talking about a shift in the pharmaceutical industry that quite honestly sounds like a bit of a science fiction, but it's happening right now in Bhubaneswar. Normally when we talk about space technology, we'll focus on satellite, internet, defense or Mars rovers. But today we are looking at how low Earth orbit might solve a problem sitting inside our hospitals. On Earth, gravity constantly interferes with how chemicals mix and how protein crystals grow, making some life-saving drugs less effective and much, much harder to administer. A Bhubaneswar-based startup named Serendipity Space is trying to change that. They, in fact, are building reusable satellites equipped with autonomous chemical factories to manufacture pharmaceuticals in microgravity. In fact, recently they took a major step towards that goal, successfully testing their autonomous drug crystallization system, which I believe is called Alchemy, during a near-space mission launched from the TIFR balloon facility in Hyderabad. Joining me for the hour is CEO and co-founder of Serendipity Space, Antariksh Parecha. Welcome to Front Page, Antariksh. How are you doing?
Hi, Andhra. Very nice to meet you, and thanks for having me.
True pleasure, Antariksh. And whatever you're doing, it's absolutely fantastic. I mean, we have to start with the origin story here. You know, the leap from really looking at a cancer ward to deciding the solution is building a spacecraft by itself is massive. So, Antariksh, take us back to the beginning. What is it that made you believe that pharmaceuticals could actually benefit from being manufactured in microgravity?
Right. So I think, I'm not from the pharmaceutical background, obviously, but I had seen this drug called Keytruda being administered all across the world, obviously, and in fact, with some of my close relatives as well who are undergoing treatment. And when patients go to the hospital, they often end up using being in the hospital for like 4 to 5 hours to get the drug administered because it's an intravenous injection. But I was doing research on that just out of pure curiosity about why is this drug so expensive, why is it so successful, and I stumbled upon a paper that was published in Nature by Merck. Merck is the parent company that makes Keytruda, and they had also noticed the same problem that patients are the hospitals ecosystems are under tremendous pressure because these drugs take a very long time to get infused into the body, and 4 to 5 hours per patient, which means that a bed will be only occupied by like 2 patients in a day, and that's a very bad ratio for hospitals to manage. So Merck actually went out and tried to make a subcutaneous version of the drug, which means that people will be able to sit at their home and take it like a insulin shot, something like you don't need to go to the hospital for that. You can just sit at home and administer it yourself. But while making that, the way to do that is to actually make crystals of the drug. But when you make crystals of anything, on Earth, they actually usually face defects on Earth due to sedimentation, convection, and buoyancy. These are like the fundamental forces that are there on Earth. And the moment you actually switch these things off, you end up getting much better drug crystals. So I stumbled upon the paper in which they had tried to manufacture Keytruda in ISS, International Space Station, and they got some stunning results as well, where they could actually convert it from an intravenous injection to a subcutaneous shot, and which can be a massive improvement in patient outcomes as well. So that's where I got the idea. But how the stuff, how the crystallization and drug research happens in space right now is with astronauts, which means that it ends up costing a lot of money and also a lot of time. And so the idea was naturally that at the root of the problems of why this has not happened at scale in space is the human. And that's where we got the insight to actually build autonomous factories which can go to space, make these things, and come back down.
All right, interesting, Antariksh. So would you say that, that is that specific pharmaceutical problem that becomes fundamentally, I would say, easier to solve in space rather than just building a better and, more expensive lab on Earth?
Yeah, so I mean, I have been asked this question that can you create something of a microgravity environment on Earth? And the thing is that you can build any machine which can go up to 1,000 of Earth's gravity, but not lesser than that, not beyond that. And usually the drugs that are the most important ones, like cancer drugs and chronic ailment drugs, they actually experience a good enough shift only beyond 10 to the power minus 3, or attaining like microgravity. So that is something that you cannot achieve on Earth no matter what kind of machine you make, because Earth's gravity will not allow you to. So the answer was that, I mean, we would have been the first ones to actually do this if it was possible on Earth, because going to space is also a tough affair, and coming back is an even tougher affair.
100%.
But the only way to do that was to go to space.
All right. Antariksh, decades of research have gone into microgravity pharmaceuticals on the International Space Station. What really convinced you that a commercial startup could make this option viable now?
Right. I think a couple of things, I mean, very specifically, two things happened in the past 4 to 5 years. We saw more and more breakthroughs in pharmaceuticals in the ISS. So not only Keytruda, there were multiple other drugs from multiple other big pharma that had at least flown to the ISS like 3 to 4 times to get these drugs crystallized and returned to Earth.
Yeah.
And that was the signal that pharmaceutical companies were actually increasing their adoption of space in doing this. At the same time, something like 10-15 years ago, the cost of sending something to space was at $25,000 per kilogram, and now it's down to like $3,000 to $5,000 per kilogram. And this means that suddenly the unit economics almost matches the same unit economics on Earth for doing these kind of pharmaceutical manufacturing missions in space, which is why I thought that it was the right time to take this forward.
All right. Antariksh, I do have a sort of a follow-up question on that. There is a massive graveyard of, space startups that try to commercialize ISS research. Why would you say is the timing right in 2026 for a seed stage company to take this on?
One of the main reasons was that ISS had plenty of research, not only on pharmaceuticals, it had research on fiber optics, semiconductors, metal alloys, bunch of other stuff manufactured in the ISS. But it is very important to pick the right candidate for commercialization. Like which of these technologies or which of these industries are ripe for microgravity to enter its domain. And purely, if you look at these industries, you would understand that the only sort of like the first use case that is bound for success is something that has a very high dollar per kilogram value. So if you manufacture something in space, it has to have economic returns which are actually very high. And if you compare semiconductors, metals, and pharmaceuticals, for example, pharmaceuticals always win. And because the dollar per kilogram value for those substances, drug substances, is much higher than any other material, because naturally it saves lives.
Understood. Understood, Antariksha. I'll shift the conversation here slightly. Moving a chemistry lab to orbit isn't just about rockets, right? It's about automation. Now, you are building Alchemy, which I believe is a factory that has to operate completely independently in one of the harshest environments possible. How much better are these crystals you are producing in microgravity as compared with the conventional crystallization here on Earth? Do you have any actual numbers that you could share with us, or are you seeing any structural differences between the two?
Right. I think the main things that you see when you crystallize these drugs in orbit is that specifically with relation to crystals, you end up getting a very uniform particle size distribution of all these crystals, which means that on Earth, if you make it, there will be very large particles like 200, 500 microns, and some are maybe like 50 microns, 60 microns. So you have both of these species, right? But when you do it in microgravity, you end up getting a singular particle size distribution, which means that all of the crystals will be like 50 microns or something like that. Right? Now, this has a good effect, for two reasons. One is that you have to have all the crystals which are of the same size for any drug to be even approved, right? Because if you have different species, then you have different dosages, it's a problem. The second thing is that if you have uniform particle sizes, you also have lower viscosity. So on Earth, if you make these drugs, they become too viscous, and they ultimately cannot be injected under the skin. But the moment you make them in space, their actually viscosity reduces because of the uniform particle size. And so you can play around with formulations a little bit to actually make it less viscous and then inject it under the skin.
All right. Antariksha, what is the first drug or molecule where you believe serendipity space can demonstrate a result that cannot realistically be achieved on Earth? Do you think there is something like that?
Yeah. So we are working across both sets of molecules, biologics and small molecules both. Biologics are protein therapeutics and small molecules are synthetic drugs, right? So we are working across both the drug classes. We do believe that I think biologics has a good opportunity to actually get some novel formulations made in microgravity. And the reason is that many of the drugs that are currently on the market for cancer, psoriasis, and a bunch of other diseases are monoclonal antibody therapeutics. And monoclonal antibodies are very notorious to crystallize. They often don't crystallize on Earth, and even if they do, they are not controlled. So you can't control the crystallization. But the moment you reduce gravity, you actually end up getting a control over that, which means that most of the monoclonal antibody drugs which are there on the market right now, we'll try to push them from an IV to a subcutaneous route for patients, so that we reduce the burden on hospitals and it becomes a better patient experience. And also, hopefully the cost goes down, because there's a lot of ancillary cost associated with these drugs because of hospitals, administrators, clinical administrators, and a bunch of other stuff.
All right, interesting. Between the microgravity processing itself, the AI and autonomous operations of your module, or would you say the violence of atmospheric re-entry, what is the hardest, technical problem that you are solving right now?
Right. So there are two difficult issues to sort of attack. One is that you need to, till we get to a point where we are flying to space every month, we need to choose our horses very carefully, which means that we need to do very, very good analysis on Earth to be sure which one is going to work in space. So that's what we try to do with most of our time on Earth, right? So once that is fixed, the autonomous factory basically is, you'll just load the raw materials and you ship it to space, and it basically starts autonomously producing these crystals. But while returning, you actually experience quite high speed of return. So, typical re-entry speeds are like Mach 25, which is 25 times the speed of sound. And you end up getting tremendous amount of heat generated, something like 1500 to 2000 degrees Celsius. And what your job is actually protect the satellite when it's coming back. So we have done tests on whether these crystals, survive such violent, acceleration forces, and we have engineered our system according to that as well. That they'll be fine, and we have done those tests. Right now, what we're doing is pushing the heat shield, manufacturing to the point where we can survive the higher temperatures of re-entry.
Okay. Antariksh, as far as autonomy is concerned, if a valve sticks or a temperature sensor fails on Earth, a lab tech fixes it. Now, if it happens 400 kilometers up, I would say the mission is over. So if you could give us some details about how are you designing the software and that autonomous system to sort of self-correct it in the orbit itself. If you could give us some details.
Right. So the pharmaceutical factory will be capable of monitoring the crystallization process as well as controlling, not only controlling. So we need to actually see what's being manufactured and what sort of crystals we've gotten, and do some detection of that. So the way to fix these, some of the potential, risks is that one is redundancy. So you end up having multiple, smaller components, such that if one fails, the other can take over, and we can have the process continuing as well. So one of the ways to do it is to have redundant systems, and the second approach is to make your payload as passive as possible. So which means that even if all your sensors fail, right, you should have a structure which actually maintains the temperature or maintains the processing ongoing without any problems and without any requirement of electricity, let's say. So we have also taken quite a good amount of effort to making the payload as passive as possible, such that even if all our systems fail, we should be able to do the basics right.
Understood. Antariksh, a couple of weeks ago, your company went viral after a successful near-space test. You're using a stratospheric balloon cut out of Hyderabad, I believe. I want to separate, the hype from the hardware and really understand the business model here. What exactly did the Alchemy module manufacture during that, near-space flight, and what did you physically bring back to the lab?
Right. So this mission was to test all of our core subsystems. So we have multiple subsystems, right? We have the heat shield systems, we have the deployment systems, we have avionics, telemetry, pharmaceutical factory, and the heat shield itself, all of these things together. So the idea was to use this mission to push all of our technology readiness levels to like TRL 6 or 7, right? Just with this one mission. So that we know that something works at a temperature and air pressure which is very close to what actual space will have, right? So that is what the main goal was. And in this process, we also ended up, basically running the factory. We had drug crystals, we had commercial therapeutics on board, and these are drugs currently on the market as well. We had proteins, small molecules, as well as monoclonal antibody therapeutics, in which we had these crystals actually return from this mission and also survive the landing as well, because we landed at a low velocity because of deploying parachutes. So we actually could also demonstrate that, we can attain a soft landing, and then we basically harvested the crystals out and we analyzed them in our labs, and they're fine.
All right.
They're intact as well.
That certainly is a fantastic way to go about it, Antariksh. Also, what is it that this high altitude flight definitively prove? That you hadn't been able to prove in a ground lab, and also crucially, what remains unproven at the same time before you have a working orbital factory?
Right. So this was what we call an orbital class satellite prototype, so which had all the necessary subsystems, right? Except the propulsion system, I think we had all the subsystems which were a prototype, class that we had tested. That how to do the basics in space, right? Because be it 30 kilometers or be it 100 kilometers or 200 kilometers, you would use the same telemetry, telecommand, software. You would use the same, protocols, etc. So a lot of the stuff that we could test was that we could reliably control our factory, during this journey, because obviously there's no contact apart from the telemetry, telecommand. And that was the most important part, where we could change the temperatures, change the mixing rates and crystallization rates, all of these things. We could ensure sitting on ground, and that was very important. And the second thing is that, on ground, we could test it in a thermovacuum facility, and we did that as well. But then all of the subsystems, how they actually perform in space, is something that, we wanted to do ourselves anyway. because
Okay.
although you could get a replication of that in a thermovac, we did want to see how communications worked, how actually our materials are surviving,
Right.
and how do parachutes deploy and how do we land safely back. So all of those
Understood.
tests.
Understood. Antaresh, let's also talk business here. Who is the eventual customer? Will massive pharma companies, pay you to act as an orbital contract manufacturer, or do you see serendipity, eventually owning the IP really and becoming a pharmaceutical company in itself?
Right. So to start with, we look at ourselves as basically like a formulation development company for pharmaceuticals. So a lot of pharmaceutical companies have multiple candidates which are in the pipeline, right? And these candidates end up facing a lot of issues with solubility, with bioavailability, and a bunch of other, drug parameters, which hopefully microgravity can solve. And so we become the gateway for them to actually have a new physical environment to try to make their drugs in. And so essentially we have an effect on how they move from, which is a small molecule, like just a molecule, to
Yeah.
something that is ready for clinical trials.
Okay.
So that's where we sort of act as, and yeah, our primary customers are pharmaceutical companies in India and abroad.
Okay, understood. Antariksh, a stratospheric balloon gives you extreme conditions, right? But it doesn't give you sustained microgravity like orbital freefall. So does this test actually validate that chemistry, or just validate the hardware durability of it?
So when you drop from something, you have a small amount of time in which you are undergoing free fall, right? And that free fall is what you use to do something. But of course, without getting to orbit, you actually don't get like days or weeks of microgravity, which is what is typically required for these crystallization processes, right? So we did run the factory and everything, but there was a small amount of time in microgravity that we eventually got. While it was not a necessity that we have to manufacture it using a stratospheric balloon drop, because we didn't expect it to, basically we didn't expect days or weeks of microgravity to be there because it's just a balloon drop. We tested all the core subsystems that are required for an orbital launch. And now, once we ship something to orbit, we'll be able to operate them exactly as we did right.
Okay, all right. Also, what is the absolute maximum cost per kilogram threshold your commercial missions need, to hit before pharmaceutical companies actually start buying your services?
I don't think we operate in a typical dollar per kilogram model, because we are set up more like a pharmaceutical company than a space company in some sense. So we actually take essentially contracts for developing these drugs, because it's not only as simple as sending or shipping something to space and bringing it back, because we have to also run the process before going to space, which means that we have a pharmaceutical company which actually works with the drugs, for a long time before sending it to space, because we need to know exactly what we're doing. We develop the crystallization processes ourselves. We know which process will work with which drug, what are the setbacks that can occur, what are the positives that we can exploit in space. All of these, things have to be researched before going to space, which is what we have set up for. So in a nutshell, we actually end up almost acting like a CRO or a CDMO would do, where they would take these drugs and then they would conduct the basic research to actually tell you that, hey, this is how we're going to manufacture it. This is how much it's going to cost ultimately. And so it's not about a dollar per kilogram value, but as a contractual value to develop a drug.
Okay, all right. Antariksh, I also want to talk about this new space race in India. Now, building hardware that goes to space and then comes back safely has historically been the domain of nation and states, and not typically startups incubated in Bhubaneswar. You are building reusable satellites with inflatable heat shields and guided re-entry capabilities in-house. Why take on that massive engineering challenge instead of treating orbital infrastructure as a commodity that you can rent?
Great question. I think the answer to the question is that we can't rent a commodity that doesn't exist. Very simply put. right? And there does not actually exist any vehicle that can, or an autonomous, real estate in space that we can rent out. We would happily do so if there was something like that existing.
Okay.
And the ISS is one of them, right? But then the access to the ISS and repeated cost and cadence is something that exactly what we're trying to solve, which is actually a bottleneck in drug manufacturing. So it doesn't make sense to go to the traditional ISS route. Instead, build the vehicle ourselves. We also realize that if we don't own the entire chain of this entire process, we also don't end up capturing the entire value. So this means that the pharmaceutical customers are not going to make their own payloads or like autonomous factories which are space qualified, right? Obviously they're not going to do that, and they're also not likely to develop the crystallization process or formulation process themselves because they don't know how things work in microgravity, right? That's some data that we will have. And number 3 is that if we also end up renting out infrastructure or outsourcing the manufacturing of the satellite, we cannot ensure any quality assurance with what goes to space, what comes back. And so a lot of that risk is transferred, which is actually a bigger risk for us. So we plan to have the entire chain. So we are building the vehicle ourselves. We will re-enter and we will also have the factory in it. So I don't think it's a major thing to address because it's something that's necessary, to do.
That you're being modest here, but all right, Antariksh. Then having said that, Antariksh, could India realistically become a hub for in-space manufacturing, or will the most valuable part of this ecosystem eventually move to the US and to the Europe?
I think in my discussions sometimes with people at InSpace and ISRO, we do agree on a common point, which is that, look, for things like reusable rockets and other existing technologies in the US, which US has almost monopolized right now, India does have a good chance of it, and we should definitely go ahead and do it. But the emerging markets of space is something that actually we do have a big chance in actually conquering. Right, and in-space manufacturing is one of them. There are not a lot of companies doing this around the world. Even there are, a handful, maybe like 4 to 5 companies around in the world that are doing this seriously with the market focus. Abroad. So we thought that this is something that India can take a lead once we fix. And the good thing is we also have expertise in re-entry. Only 4 nations have actually re-entered a space capsule from space and landed it back safely. Back to Earth, and India is one of the 4 nations to actually have done it. Long back, but we do have the expertise. So we thought that the right units exist. We just have to put them together.
Okay, all right. Also, Antariksh, what does the Indian tech and venture capital ecosystem really need to change for deep tech hardware companies to really move from prototypes to, I would say, repeatable commercial missions?
I think Indian venture capital is actually doing a pretty good job already to start with. If you compare it maybe 5 years before, our time when space was just privatized, right? I think they're at a much better level where they are willing to take risks that even somewhere in the world might not. Like UK might not, Europe might not, but India might just take up the risk, which is visible with us as well. I mean, we also got funded, and I was not expecting that. Okay, it'll be like I was expecting a lot of ridicule, but I think VCs did have a sense of exploring that. Okay, what is it exactly that you're doing, and they didn't pass it off as something ridiculous.
Okay, so you said that there was no apprehension per se.
No, I mean ultimately you can choose to let the deal go by or something depending on what you think of the idea, but they didn't ridicule the idea as in like, oh come on, you guys can't be serious, right? There was no reaction like that from Indian VCs, which is what I loved, because they were like, immediately the moment I pitched it as a serious idea, they were considering it as a serious idea as well. But apart from that, of course, there needs to be more capital infusion, and that is, I think every founder will tell you that, because the scale at which US operates or Europe operates or UK operates, they have enormous capital flowing in. So India does need to have that, and I think we are seeing a trend in that rising, and hope it continues.
All right. Antariksh, you, I believe, met the Prime Minister recently, I believe just last Friday. Tell us something about that conversation. Did that conversation give you the confidence that regulatory bottlenecks for private space recovery in India are actually being dismantled? Did it go along those lines?
Absolutely. I mean, it was a great meeting, and Prime Minister Modi is very sharp in actually understanding something just right off the bat. So he immediately got what we were doing, and he's talking about APIs and stuff like that. I was like, okay, great. That was something very cool for us to see. So it was a very enthusiastic meeting for all the space startups to go ahead and do whatever we want. Most importantly, also, I think policy is keeping up now, because we have the first guidelines of re-entry published by InSpace as well. I think that was a great step in the right direction for actually making India ready for re-entry capabilities, right? And landing satellites on its own soil. I think that was a major policy win to start with, and we will be seeing more versions of that re-entry policy come into existence as well very soon. And the good thing is also that when Serendipity talked to InSpace and a few other ISRO personnel as well, we always pitch it as, look, this is a new economy that can be created for India. We're not talking about ourselves here. Like, yeah, sure, we'll be able to land a satellite maybe in like Run of Kutch or like Ladakh or something like that. But ultimately, if you are able to make a policy where others can also land their satellites, you are actually generating a new economy in India. Because once they land their satellites here, they will do all the analysis, testing, all of their vehicles in India. So you will actually see a birth of a new range of startups, new range of services actually. So India can become the re-entry corridor of the world. And that's what our pitch was. And that's the reason that new policy needs to exist, not because we want to do it. We can re-enter anywhere. We can re-enter and land in Kazakhstan. We can re-enter in Australia. That's okay for us. But India taking the strategic route is important.
Okay, absolutely. Serendipity Space is essentially attempting a fundamental rethinking, I would say, of the global supply chain. Now, if low Earth orbit becomes a space, or I would say a place where we manufacture superior medicine, it would essentially bridge these two industries, right? Aerospace and biotechnology, and which used to exist in completely different universes. Now, whether space becomes the next standard factory floor for big pharma remains an open question. But as hardware costs drop and autonomous systems evolve, that line between earthbound technology and orbital manufacturing, I would say, is blurring faster than ever. So tell us something about this, Antariksh. How did you really come about it in the first place? I mean, this is something that has not been attempted before, as you mentioned. This is something that people wouldn't even have imagined, let alone attempted. They wouldn't have even imagined in the first place. So while you tell me that VCs were actually encouraging about it, there was no apprehension per se, but I would say there was still maybe some sort of back and forth. So take us through that, like give us like some, path into your brain. How were you thinking about it? How did you even imagine that something of this sort could be attempted at such a scale at that?
Right. So, I mean, it was pretty simple. So I was back in Europe back then. I was doing my master's, and I was reading up about these kind of the ISS research basically. And I stumbled upon these papers that basically talked about a lot of these drugs being manufactured there. I ultimately thought that, okay, I am very close in proximity to these pharmaceutical companies in Europe, so I should maybe take a train and just go and meet them or something, right? So I just used to go there and meet the principal scientists of big pharma companies, and I ultimately asked them that, hey, you clearly have gotten great results. Why haven't we done it? Like, why haven't we seen a drug on the market yet, which has been made, manufactured in space? And they went on a 1-hour rant, right? Okay. And this 1-hour rant eventually became Serendipity, because they basically said that, look, we want to do this. It's costing us like $50-60 million every couple of weeks. This is tremendously expensive. And also, whenever we want to send something to space, we don't get it. It's almost always that you have to align with astronauts' timelines. So whenever they go, you send something. Whenever they come back, you get the thing back. So it does not exactly match with the pharmaceutical companies' timelines. So I was like, great. So at the both of the roots of both of these problems were the humans. And I was like, okay, if you did have an autonomous factory that could do this, they're like, yeah, that would actually work. And that was when I realized that, okay, some customer sort of respite actually was what I sensed, and I was like, okay, this is something to go out and build.
Okay, fair. Antariksh, what is next? What is next in your pipeline?
Next is orbit. We tested the core subsystems. We are exploring now a few launch opportunities, in India, abroad, to actually launch our pharmaceutical factory to space. And then that will be our first, sort of like orbital mission, and followed by successful re-entry as well in the next orbital mission as well. So we want to spread these two engineering challenges out over two orbital missions.
Okay.
So ultimately, by end of 2027, Q1 2028 is when we want to have the first commercial mission to space, and then return and land safely back in India.
Okay. Okay. All the very best for that then, Antariksh. I think this has been a very, very intriguing conversation. Thank you so much for your time. In the interest of time, again, we'll have to wrap this segment, but this is absolutely unheard of before. So what you're doing there, all the very best for your future endeavors on that. And ladies and gentlemen, whoever has tuned in right now, thank you for watching. This was Antariksh Parecha joining us and taking us really inside the tech. So thank you all for tuning in. Make sure to subscribe and leave your thoughts in the comment section. This is Front Page by AM Network. We'll see you soon again.